Dassault System is a leading 3D design software provider similar to Autodesk's with brands like CATIA. They are operating in several growth segments and the fundamentals of the company show every sign of a great compounder. But is it also a good investment? Well, in today's video I'll break it down. I look at the business models and the markets of Dassault, analyze their position by doing a Porter's 5 forces analysis, and have a look at the latest financial statements to see how they are doing. I'll also check the valuation and do a discounted cash flow calculation to determine their fair value. So sit back, relax, and let's explore Dassault's investment potential together. My name is Florian, welcome to Cashflow Maniac. Dassault has the ticker symbol of DSY on the Euronext stock exchange, but they are also available with DASTY on the OTC. They are working in the information technology sector and were founded 1981, actually 1 year before their main competitor Autodesk, and they have more than 25,000 employees. The headquarters is in Vélizy, Villers-Cotterêts, and their market cap sits at $55 billion at the moment. Dassault Systems started revolutionizing 3D CAD software, which actually stands for computer-aided design, with their CATIA software in 1981. During the 1990s, they expanded their offerings with Innovia and Delmia, covering more stages of product development. Going public in 1996 enabled them to enhance their market presence with acquisition like SolidWorks in 1997 and IBM's PLM division in 2010. Their 3D experience platform integrates various tools into a collaborative environment. The recent years saw them enter new sectors like healthcare sector with the acquisition of Medidata in 2019. Today, they are a global leader in 3D design and PLM software, focusing on innovation and sustainability. And while the biggest competitor, Autodesk, focuses more on engineering, architecture and the construction industries, the focus of Dassault is more on product design, virtual planning and modeling the manufacturing process. In the 1990s, their software was used to develop 7 out of 10 aeroplanes and 4 out of every 10 cars worldwide. Their brands support many industries across the manufacturing, life science and healthcare, and cities and infrastructure sector. Here, their products help to boost productivity and product quality, improve business resilience, and facilitate sustainable innovation. Their CATIA software is a leading CAD software that enables complex product design and engineering across various industries, including aerospace and automotive. It excels in 3D modeling, allowing users to create detailed and precise digital models. Innovia is a product lifecycle management software, or PLM, that manages data and processes throughout the product's lifecycle, from conception to retirement. Delmia focuses on digital manufacturing and operations, providing tools for virtual product planning, simulation and execution. It helps manufacturers optimize processes, improve efficiency and reduce costs by simulating production scenarios. And their 3D experience platform is an integrated environment that connects all of Dassault System's software tools, enabling collaborative innovation and data management. It provides a unified interface for all parties involved and supports digital twins and advanced simulations. Their revenue is well diversified by region, and while the Americas has the biggest market share, the growth is actually the lowest here. Americas make up around 41% of the market share, Europe 37% and Asia 22%. In the last quarter, they had the biggest growth in Asia though. Dassault reports 3 different product lines here: industrial innovation, life science and mainstream innovation. And please note that they mostly report their software revenue here, but their software revenue makes up the vast majority of their revenue. They have a small additional revenue that comes actually from service contracts, but this is only a very minor part. So in their software revenue, the biggest part actually makes up the industrial innovation software, followed by the mainstream innovation software, and last but not least, the life science. Compared to the first quarter in 2023, they could show some nice growth in the recent quarter, but we can also see that the exchange rate did hurt them quite a bit. So the overall growth of the software revenue in this time frame was about 5%, and when we exclude the exchange rates, it was a bit higher, around 7%. And while this is nothing to write home about, when we look at the financials later on, we see that they have a very, very stable growth, a very predictable growth on a year-over-year basis. What is very nice to see is that in the last years, they have switched from a license and non-recurring software revenue more to a recurring subscription-based model. And as of today, the subscription make up about 84% of the total revenue. This is very nice to see and also helps the predictability of the revenue, especially when we take into account that some of these contracts have a very long runtime of up to 5 years. The 3D CAD software market is expected to grow with a CAGR of around 6.7% per year on a global level. And here we can also see that the growth in the US is a bit slower. It's around 5.3%. This market trend is driven predominantly by industries such as manufacturing, automotive, aerospace, and construction. 3D computer-aided design has become an essential tool for innovation. These platforms enable creators to build detailed 3D models, transforming traditional design methods with greater precision and efficiency. Trends are shifting towards cloud-based solutions, meeting the global demand for agility and collaboration. So, design professionals across various locations can now work on shared models, resulting in the reduction of cost, time, and resources. Additionally, the integration of virtual reality and augmented reality with these 3D CAD softwares can improve the design understanding. Basically, in VR, you can directly see what you are designing in front of you. Another important trend is the commercial 3D printing. As this manufacturing technique gets more and more momentum, the demand for 3D CAD softwares also intensifies with progression in many sectors, such as medical and aerospace, but also consumer products. When we look at the strategic position of Dassault systems, first of all, I would estimate the threat of substitutes as medium to low. The software industry in general has relatively low entry barriers. However, the existing players in the 3D design software market, namely Dassault, Autodesk, and in some cases also Siemens, have established themselves as de facto industry standards, and their size, brand name, and customer loyalty makes it very hard for new players to enter this niche. The threat of substitutes I would estimate as medium. Dassault is a leading company in the areas and offers innovative technology solutions that are often critical for their customers' workflow. But there are some alternatives out there, even free ones like Blender. So Dassault has to focus on constant innovation to retain their competitive edge. The shift to a subscription-based model with many of the customers also helps to stay close to them and increases the effort for switching. The competitive rivalry, on the other hand, I would estimate is quite high. In this 3D design software market, the competition is fierce between the few main competitors. With their effort on innovation and acquisition, Dassault is constantly trying to expand their offerings to other markets and to provide an end-to-end solution to its customers. The bargaining power of the customers is medium. As we already established, there are some big alternatives out there for Dassault software. However, there are significant switching costs for bigger customers that comes with the familiarity and the training on certain software and the integration in their customers' workflow. Sometimes even with custom tools or custom UIs or with integration of certain services. The size of many of their customers, like big corporations or governments, still gives them some bargaining power. The bargaining power of their suppliers, on the other hand, I would estimate is quite low. Dassault is developing their software in-house by themselves. They do not rely on many external suppliers except the ones that are necessary to operate their infrastructure, such as operating systems, development and CRM tools, and so on. This makes up only a very small portion of their costs. So overall, I would say that the strategic position of Dassault is quite good. And while the competition, especially with the main competitor Autodesk, is quite fierce, both of the companies are operating in slightly different segments. So each of them still has their own piece of the cake. So before we jump into the financial details now, if you do like the video so far, please smash the like button and consider subscribing to the channel. It would help me out a lot. Over the last year, the performance of Dassault compared to the S&P 500 wasn't too good. Especially in the first quarter of 2024, we can see here quite a significant drop compared to the S&P 500. The same is true if you look at the total return of the last 5 years. Here we see that the performance over long periods of the time have been on par, but again, in the first quarter of 2024, the performance of Dassault stock wasn't too good, and right now we have quite a big gap in performance between the index and Dassault. Over the last 10 years, it looks a bit different. Here, Dassault could outperform the S&P 500, but only by a very small margin. This is actually a bit surprising to me, because if you look at the financials of the company, we see that most metrics like total revenue, net income, but also free cash flow and operating cash flow have a very, very nice uptrend over the last decades. And we are looking at the performance of the last almost 20 years here. So this is not like a temporary snapshot, but the company did prove in the past that they can keep this performance over very long periods of time. The margins are also very stable. We have an operating margin of a bit higher than 20% on a regular basis. Net income is even increasing over the time, and right now we are sitting at net margin of a bit higher than 17%. And return of invested capital also quite stable around this 10% value. We can see a dip in 2020, but this is mostly due to the acquisition of Medidata in 2019. Actually, we have a revenue growth of around 10% with a 5-year CAGR and even higher on a 10-year basis. A net income growth of around 12% on 5-year CAGR and 10-year CAGR. And for the free cash flow and for the operating cash flow, we can see that's unfortunately a bit flat over the last 3 years. Here, we still have a 5-year CAGR of around 5% and a 10-year CAGR of still almost 10%. So we see that the 10-year trend for free cash flow is still quite good. But after the huge jump in 2020, where we had an increase of around 30%, the numbers just came down a little bit. But over the long run, the growth is still very stable. In just a second, we will have a more in-depth look at why it is stable over the last 2 years. But first, let's also check the balance sheet. Here we also see a very stable growth trend for the EBITDA, and we also see that the non-current liabilities of the company can be covered by the current cash. Even if we exclude the cash, the non-current liabilities can be covered by 2 times the EBITDA. The company is also paying a dividend, and the dividends are also well covered by the free cash flow. Unfortunately, over the last years, the company has not buying back shares, but instead we have a share dilution of 0.3%. And while I would rather see the company buying back shares, I think at the current level, this is still acceptable. The forecast for the next years also looks quite nice. And here we have a very steady increase in EPS as well as revenue. And the average 1-year price forecast from the analysts point up to a 22% upside, on maximum even 40%. The downside, on the other hand, seems to be quite low, with around 12% for the minimum estimation. So the company seems to have a very nice risk to return profile at the moment. So what exactly is the reason for the stagnating growth in free cash flow and operating cash flow? In their annual report for 2023, they distinguish between IFRS income and non-IFRS income. This non-IFRS income is the equivalent to the non-GAAP income for American companies. When we compare both of them, we see a significant difference. For IFRS, the operating income did decrease by 5% on a year-over-year basis, while the non-IFRS metrics increased actually by 2%. And not only that, if we exclude the exchange fluctuations, the increase was actually around 7% for the non-IFRS. So what is the difference between the two of them? In the non-IFRS metrics, the company excludes certain costs like one-time tax effects, the amortization of intangible assets, and certain one-time items including in the financial income. But they also exclude things like share-based compensation, which from my point of view shouldn't be excluded. So even though the trend looks much nicer here, I would not rely on these non-IFRS numbers 100%. The main reason for the decrease in operating income is actually the increase in operating costs. And this is mostly related to an increase in headcount in their R&D and marketing and sales departments. And of course, while this is not nice to see in the short term, over the long run, the company hopes to generate more business this way and to improve their systems and their whole ecosystem. Before we sum this up, let's also have a look at the valuation. And as usual, here we look at the EV to EBITDA, PE gap, and price to cash flow multiples over the last 10 years. And while these multiples have fluctuated around a little bit and in general have increased over this 10-year time frame, at the moment they seem to be about average when compared to their own history. As a dividend payer, I also like to look at the average dividend yield over the last 5 years in this case. And here we see that the company right now is actually paying quite a high dividend when compared to the last 5 years. So from a dividend yield perspective, the valuation seems to be rather on the lower side. Of course, Dassault is not alone in the market, so let's also compare them to their main competitors, which is Autodesk, PTC and Trimble. I also mentioned Siemens before, but because Siemens is a huge company with many different business fields, I have excluded them here because only a small portion of Siemens business is generated in this sector. And when we compare the valuation here, PE to GAAP, EV to EBITDA and price to cash flow, most of these players are actually very similar, with Dassault Systems rather being on the lower side of this range. We also saw that Dassault is a dividend payer and they currently have a dividend yield of low 0.6%, but their payout ratio is also quite low with only 23% payout ratio from revenue. The 5-year dividend growth rate, on the other hand, sits at a very nice 11.2%. The fair value of the company by using the discounted cash flow model, multiples calculation and the Gordon growth model seems to be a bit lower compared to the current stock price though. For the growth rates, I used the average of the last 10 years here, and for the multiples, the average of the last 5 years as usual. For a long-term dividend growth rate, I assumed a value of 7% here, which is quite a bit lower compared to the values we just saw over the last 5 or even 10 years. And with these assumptions, we come to a fair value of around 36 US dollars. And by including a margin of safety of 20%, we are only sitting at a fair value of 29-ish. This is quite a bit lower compared to the current stock price. So from this point of view, the company seems to be a bit overvalued. In my analysis, I also found the interesting fact that a huge portion of the company is actually in private hands. Around 40% of the shares belong to Marcel Dassault, who is actually also the owner of Dassault Aerosystems. In addition to this 40%, around 20% is owned by institutions and 8% by individual insiders, which only leaves around 30% of the shares open to the public. So to come back to the questions, if Dassault Systems is a good investment. The fundamentals of the companies look remarkable, with a very steady and predictable uptrend over the last decades. This is no surprise as the company is operating in a growing market with a secular trend. Their shift to a more subscription-based model with very long contract times will also help keeping this revenue stable over the next years. And while the valuation is not cheap, it never was over the last 10 years, and compared with their peers, it is rather on the lower side. The company is paying a small dividend, and while there have been years where the dividend was cut, the company could still increase the payout by more than 10% per year over the last 5 years and still more than 8% per year over the last decade. So I think that the company has a lot going for them, and while I'm not invested at the moment, I'll definitely keep my eyes on them. But please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys. If you did find today's video helpful, please smash the like and the subscribe button in order not to miss my next video. And if you're looking for another company that might also fit your long-term portfolio, this one might just be the right one.